All right, why don't we go ahead and get started? So thank you guys for joining. I will introduce Peter, who probably doesn't need an introduction, in a second, but we have to go through a couple housekeeping items. Of course, I'm Mark Lamonic. I look after the individual investor business for Morningstar here in Australia. But first, and for people who've tuned into these before, you should have memorized these by now, but anything you hear today is general advice. So Peter and I don't know anything about you. We can't offer personal advice. If you're over in New Zealand, you can go under our website, morningstar.com.au, and find a copy of our FAP. The New Zealand regulatory authorities encourage you to go talk to a financial advisor if you have personal questions. But what we would like today is to get lots of questions. So obviously you guys have access to Peter today. So fire out any questions. Any questions that you have on anything that happened in earnings season, and we'll get Peter's opinion. So what we'll do is we will initially just let Peter kind of give an overview. So, Peter, I've read obviously your earnings season wrap-up report. I think we've seen a lot in the media that there has been, I guess, this notion that this was a great earnings season. I think you took a little bit of a different approach. You kind of separated the miners from everything else, and obviously talked a lot about the government support that is propping up a lot of companies. So maybe just an overview from you to start things off.
Yeah, thanks, Mark, and welcome everyone to this reporting season webinar. It's unfortunately, we are in the situation that we can't see each other, we can't talk to each other, and we can't connect, if you like, physically, but still in all, that's the cards we're dealt, and we've got to handle them the best way we can. But this reporting season, as I said to the guys before they started, the report started to flood in, I said, just don't forget that this reporting season will be nothing like the reporting season of 2020, which was nothing like the reporting season of 2019, and it won't be anything like the reporting season of 2022. The COVID has spread across 3 or 4 reporting seasons, as we do half-yearly totes up, if you like, of what companies have been up to. And so this particular reporting season has been basically the first one where we had one whole year of virus influence, if you like. 2020 was only kind of 3 months, but 2021 was all of it. But it did comparing it to a base that was devastated in the fourth quarter of 2020. And so whilst, reading the reports that were saying, it's a terrific reporting season, and it was, don't get me, let's not gild the lily, it was a very good reporting season for most companies. Obviously the outliers, positively and negatively, are very, very easily to see. But generally the belly of the corporate world did reasonably well, despite the fact that we had virus influences right throughout the reporting period, the 1 year to June 30, 2021. Clearly, the miners were the standout. The iron ore miners were the standout on the positive side. On the negative side, obviously, hospitality, leisure, anything to do with lockdown, border closures, and what have you, they were obviously impacted very, very significantly. There was a lot of other companies in there that were supported by fiscal and monetary support from the central bank and the government, as they should do when the economy is in distress. And the influence of that was very, very significant. We will be paying off that debt for decades. But it had to happen. We were in ICU and near death, and they had to do something very, very significant. And they delivered it with a bipartisan approach, which obviously was also positive. and much, much better than the US did in their situation. So again, looking at this reporting season, the balance sheets were in pretty good shape, and those that were a bit, if you like, on edge in 2020, they went to the market and raised new equity, and that was one of the reasons why the balance sheets were in basically in solid shape in 2021. And of course, those reporting solid profits rewarded their shareholders, and the dividends and other capital initiatives were very, very welcome vis-a-vis what happened a year ago. Now, is that sustainable? Is the flow of free cash flow into shareholders' pockets going to continue? The answer is yes, it will. Will it be as great as have you seen? The answer to that, I doubt. Because let's just have a look at the basic fundamentals of how a corporate works and how it distributes its free cash flow. There are only three buckets that can be addressed, and they are CapEx, in other words, growth CapEx. Number two is looking after the balance sheet, the financial well-being of the company. And the third bucket is shareholders. The first bucket, growth CapEx, very, very few companies pushed the investment button in 2021. If you go and look at where business investment as a percentage of GDP has fallen from 18% 5 or 6 years ago to less than 11% now, and any of the heavy lifting has been done by the resources and mining sector. The industrial sector has done very, very little, and actually it's been contracting for years. So there was the bucket for CapEx wasn't filled. The balance sheets, as I mentioned earlier, was okay because they had been repaired in 2020 and through early 2021. So the only other place for that free cash flow to go was into shareholders' pockets, and that's where it ended up. Don't expect a repeat going forward. When we come out of this pandemic problem and businesses get more visibility and when we start normalizing, then business and the management will get on the front foot from the investment point of view. So then the demands for growth CapEx will increase. And whilst the balance sheets might still be okay, that the demands for growth CapEx will take away what the percentage of free cash flow that would have normally gone into shareholders or went to shareholders this year. So don't expect significant increases in dividends next year, and I would be just a little. I'd let cash build a little. At this point in time. Overall, we can talk about individual companies, and I'm sure we're going to have a lot of questions, which I welcome. I just think that this reporting season was solid. It wasn't outstanding by any stretch of the imagination, but it has put a lot of companies back on a good keel, and looking forward to the economy reopening, recovering, and getting back to more normal conditions.
Okay, so should we get to a couple of questions, Peter?
Sure.
So you mentioned income and you mentioned dividends. So we do have a question. This was actually a topic that Lewis Jackson covered in an article. But for income investors, if we look at the ASX, we have seen a lot of superannuation funds or private equity funds come in and buy, particularly some of these infrastructure companies for these cash flows are generating. So we saw Spark is kind of the most recent one. So we do have a question on here, just saying, what's the future hold for ASX listed income stocks given low interest rates and of course this increased private equity in the market taking these companies private?
Yeah, well, again, private equity is they're if you like major beneficiaries of low interest rates, and more importantly, not so much low interest rates, excess liquidity created by the central banks. There's so much liquidity out there. Risk asset markets must go up, and they have gone up, pushed by liquidity, for no other reason. That's been the major driver of risk asset markets. If you can't get liquidity, the asset prices can't go up, and that's one of the reasons why I think you'll find, before we just get on to that question, is that whilst the Reserve Bank is not going to put up interest rates, I don't think they're going to put up interest rates till 2024. And you've got risk asset prices, but more importantly, let's look at the housing sector. The housing prices are going north at a very, very rapid rate. Then the Reserve Bank's not going to do anything for interest rates, but what will happen is macro-prudential measures will be introduced by APRA, like they were in 2019, to say to the banks, sorry, you can't lend that amount of money to that sector of the market. The Reserve Bank of New Zealand has already done it, and it's going to start doing it again, another cut at it. And so what I'm saying is liquidity is going to reduce. They will reduce liquidity, and that will put pressure on risk asset markets. Certainly put pressure on, you'll see more supply coming into the system in the housing market, and that's going to put some dampening on the rate of growth of price increases. Now, getting back to private equity and infrastructure assets and income, don't forget that the infrastructure assets and the REITs, in other words, the businesses that are based on that generate the asset based, they are the income producers. They have got the sustainability in their cash flows. So the private equity camp, they want to go in there, and that they see opportunities ganging up with super funds. Now you've seen them in Sydney Airport, Spark, and there'll be others. The super funds have to match their long tail liabilities, i.e. paying out super or pensions to their members for years and years and years, as long as that member is on this earth. And so they want to match up the asset or the cash flow of the asset with that liability. Private equity wants to get into the party because they think that again, every time you see a takeover, someone that says it's opportunistic. Excuse me, why would you make one that's not opportunistic? For goodness sake, I mean, of course they're all opportunistic. You want to see a bloke on his knees and then take the opportunity, because when he gets back up again, he might hit you. So the thing is that these guys have got so much money, they've got so much cash coming in. That's the super funds. And the private equity have got so much liquidity at their availability, if you like, and so they're targeting these assets. It would be we don't want to see that happen, obviously, because that takes away the number of opportunities we as investors have to access those cash flows, those sustainable cash flows. And particularly if they're overseas, private equity, or overseas super funds, like, half of Canada owns half of Australia, if you like, So we've got to be careful as to what we allow to go offshore. But that's why I continue to like asset-based companies for income, Horizon, APA, those type of companies that have got sustainable income streams. They're going to be sought out by raiders and I think that they will, and if they don't get sought out, they'll continue to be very, very good investments and give you a very, very reasonable return, particularly in the environment where you're getting basically nothing for cash. I think APA on a 53-cent distribution is probably yielding you north of 5%. And I think what you've got to do now is you've got to reset your expectations that between your total shareholder return going forward, I think is going to be somewhere in the high single digits, nothing like the 15 and 18% we've had in the last year or so.
All right, so it's somewhat related. So we have a question from Angus talking about utilities and just asking why have utilities performed so poorly? So any thoughts on that, Peter?
So I presume those utilities you're talking about, AGL and Origin Energy. The others have been reasonably okay, but those two have really been caned, and it really is a part of their operating portfolio that's got them into a bit of trouble is their electricity generating assets. A very, very high wholesale price has really put those assets under a lot of pressure. What we're seeing is that those are coal-fired, a lot of them. There's been a lot of problems again with the funding of coal-fired operations, and the AGLs and Origins have really been caught out there, given that they've got some legacy contracts on the from a coal point of view. In other words, their coal pricing, but the wholesale price has given them a lot of problem on the generating side, and the margins are very, very fine there. In fact, they're losing money generating. They're making money on the retail side. But don't forget, the COVID has impacted demand from commercial and industrial. Obviously, the lights aren't necessarily on in towers in the city, and et cetera, and the retail market has also, despite the fact that there's a lot more people at home, the conditions there have been nothing fantastic. So those two companies, we believe that there will be a recovery in the market in terms of the wholesale price. I said wholesale prices were too high. Wholesale prices are too low. The wholesale price of energy prices have been too low, and that's why the generators have been under the whip. We expect a recovery in the wholesale price of electricity, and that will help the generators. But it's going to be another 2 years at least. There will be earnings which should be down again in 2022, flattening in 23, and then look like a little bit better going forward.
We've opened up, I think, a number of questions about utilities, so we'll just kind of keep going on the same topic. So we've got a question. You were mentioning coal. We've got a question about sort of ESG risks, and maybe it'd be good just to sort of hear your opinion about how we kind of think about whether it's coal or whether it's other fossil fuels, sort of how to think about ESG risks when we're thinking about utilities.
Yeah, well, I mean, all I know is that the world needs energy. It's a matter of what source of energy is going to be. It's going to turn your lights on. My feeling is that the ESG fear has created some opportunity in some areas, but generally speaking, if you've got the whole world seems to be climate change and ESG just emboldened, if you like, saying where you've just got to commit to those two things. I think that yes, you have, but how you get there is a different situation. These things are gradual; they're not instant. And coal will still be generating our baseload power for quite a few years. So will gas as a medium of, if you like, peaking. We haven't embraced uranium. I mean, if you really wanted the answer to your prayer in terms of baseload, uranium is almost the place to go. Yes, we've had Fukushima, and yes, we've had something island in the US and Chernobyl and what have you, but it's a little bit like, the coronavirus. I mean, if what are the chances of getting a blood clot? 1 in a million. Well, how many major uranium or nuclear problems have we had in the last 30, 40 years to given, the benefits of that? So my gut feel is that solar and wind will continue to again increase their portion of the total energy suite, if you like. But again, they are not reliable. You can't classify them as reliable until you get the storage capacity and what have you, which I think is still a long way off. You can't store this forever. And so, baseload power from reliable sources is still going to have a use, if you like. And so, yes, we've got to embrace climate change and ESG. They are going to influence the prices of quite a number of stocks out there, because if you just think about, let's just think about Amazon, for example. ESG, is there any ESG risk in Amazon? People say no, there's no it's all online and what have you. I can tell you how many boxes are going around the bloody world delivering all the stuff on Amazon. You'd go to the mall, you'd go to Westfield and pick it up, and you'd stick it in a bag, and the bag you've had, the demand for cardboard must be unbelievable at the moment. The number of boxes that Australia Post is delivering and what have you. So it's the ESG risk. You can make every company out there's got ESG risk, in my opinion, but it's just a matter of how you rate it or rank it, and how the market then takes it on. I mean, I quite frankly am a bit over climate change and ESG, and I just like to get back to how we used to analyze companies without all these other things going on. But still, that's the changing world we live in.
All right, so let's once again, we'll stick with utilities for a second. So Fiona has a question about AGL. So of course, AGL is going to split into two separate entities. I guess any sort of feelings about AGL. So she's asking, will AGL shares plunge further south? If so, should I sell now? Obviously, Peter can't offer personal advice whether you should sell, but any thoughts on sort of the AGL share price and where you think it's going?
Well, as I said, the wholesale electricity price, we believe has bottomed and will probably flatline maybe around these levels, and then start improving going into 2022 and into 2023. That will help the generating side of the business. In other words, that one that is got power stations in it, and obviously then got ESG risk because it's their coal-fired. But don't forget that they will also be drawing on renewable investments as well. The other side of it, obviously, is their retail operations, which has it's got a big chunk of market share, particularly in New South Wales, and that is a valuable asset. They're adding to it, obviously, with telecommunications and other products. gas is going to be around for quite a while, and so that part of the business should be okay. Business needs energy, and they've got to buy it from a supplier. Households need energy; they've got to buy it from a supplier, and AGL has a good position there. I would think that AGL's it's probably in the plus zone rather than the negative zone at this point in time. I think that it's probably been overdone. That's my gut feel.
Okay. Thanks, Peter. So got a question from Andrew. So Andrew owns both Santos and Woodside and wanted to get your opinion on those. So, we'll switch over to the oil side of things.
Yeah, well, again, the oil and gas space has been overwhelmed, in my opinion, by ESG. That there'll be no more oil and there'll be no more gas wanted. In future, my feeling is that is way too negative. I think that you will still have internal combustion vehicles on the road in 2040. And I think that you'll still have a lot of gas and a lot of LNG being used in 2040 as well and beyond. The rationalisation of the space, which is occurring right now. I mean, today Santos and Oil Search have inked the deal. Woodside will increase its footprint, if you like, in the space by acquiring or merging with the BHP Petroleum side. And these are meaningful companies now in scale. Well, Woodside's always been a bit scaly, if you like, but now it's even bigger, and it pushes into the top 10 in the world. Again, the BHP acquisition brings them more oil. It doesn't bring them much gas, albeit we've still got the Bass Strait gas fields, but it's got more oil and more offshore oil, obviously. But Woodside is basically a gas producer. It's got long-term contracts with very, very big partners. It's got controls through Pluto and other big investments, some very, very major fields. And we think that the stock price is way undervalued. Similarly with Santos, so they're both. The whole sector is tarred with the same ESG brush, in my opinion, and I think that's again a little bit too negative. Don't forget that when the bans on smoking, came in, and if no one wanted Philip Morris or Rothmans or what have you, they were very, very good investments, because these people have still got very, very significant free cash flow. They're generating a lot of cash flow. Recall what I said earlier, there's 3 buckets where cash flow can go. If there's no growth CapEx, then that's one bucket which can be, you don't have to address. And if your balance sheet's in good shape, which both of them are, then more and more of the free cash flow comes back to shareholders. And so if the ESG bandwagon all of a sudden makes these guys say, well, I've got reserves and my infrastructure's in place for the next 50 years. I'm not going to expand. I'm not going to make any more investments. All I'm going to do is reap the cash flows from those things. The shareholders will have a picnic in terms of returns.
All right. Well, speaking of big cash flows going to shareholders, we do have a question on BHP and Rio. So Glenn is asking, what's your view going forward on iron ore prices? And what is the impact going to be on both BHP and Rio? And then, is it time to potentially pair positions?
Well, you'd have to ask what the Chinese are going to do, because that they're going to be, they influence the iron ore price to a significant, well, not to a significant degree. Everything they do influences the price of iron ore and coking coal. So if they want to pull back on their fixed asset investments and are serious about, zero emissions, which I don't think they are, then the iron ore price is coming. It will come down further. I don't believe you'll see iron ore prices back with a 2 in front of them for a long time. In other words, 230. I don't think you'll see that for a long, if ever again. You should never say never. But BHP and Rio, they're just blessed with that Pilbara region that is the world's largest in terms of size, but also high grade. And so in terms of where they are on the cost curve, makes them very, very competitive regardless of where the price is. They are going to make more money than any competitor basically out there. And that will include whatever the Chinese are doing in Africa as well. And so look at the asset, and the assets are first class. We have a freight advantage over the competition from South America and from Africa into the major buyers of iron ore being directly north of us. And so those are two big ticks in the box of BHP and Rio. Would I buy them at these levels? I'd be, again, I think there's more room on the downside for the iron ore price. I think China will gradually pull back on its fixed asset. It's done such a hell of a lot. And I think I wrote in the overview this week, and I couldn't believe what I was writing, and whether I believed it or not was as a moot point. But it's a fact that since 2003, every 2 years, China has poured more concrete than the US poured in the 20th century. Now, what did I say? Every 2 years, they poured more concrete than the Yanks did in 100 years. Now, with concrete goes steel, and with steel goes iron ore and coking coal. That's why the price of iron ore has gone up. That's why China has basically helped Australia out of almost recession in both 2010, 11 and 12, and again now. Their fixed asset investment. So I think that you get booms and busts, and I think you've probably had a boom in iron ore, and I think that BHP's profit will possibly be higher this year, because last year the average price of iron ore was only 155, and only 155. And this year it's probably going to be about the same, if not a little bit better than that, because it's despite the fact that it's very, very weak now. But coking coal and copper are still very, very significant contributors to BHP's bottom line. Rio's a bit more exposed, although it's got some copper. So I'd still think you've time's on your side. I don't think you need to rush into either of those two stocks at this point in time. But I think you'll still get some very, very robust dividends in 2022.
Okay, great. So let's stick with the theme of digging stuff out of the ground. Any views on lithium? So lithium has obviously been very popular. You talked about electric vehicles, and obviously it's a major ingredient in batteries. Any views on lithium and any opportunities there?
Well, Mark, we don't cover a lot of the lithium stocks out there. We've Mineral Resources have got some exposure now. Wesfarmers have got some exposure. There are obviously, smaller companies there. Pilbara Minerals, I think it's called, and October or something like that. But and obviously, I mean, if the world is going to electrify its entire transport fleet, then the lithium for batteries and don't forget nickel. The demand is going to be there for many years. I mean, so you're going from basically zero, in terms of the number of vehicles out there. And they're all saying, now that by 2040, they'll all be electric. Well, I don't believe that either, but there'll be probably 50% of the fleet is probably going to get there by 2040. And so the demand for lithium is going to. It's a bit like iron ore. The demand is going to be there. But if the price goes too high, it'll bring on new supply. So you've got to be a bit careful as to how you play it. And of course, there'll be everyone wants to get on the bandwagon. So there'll be a few people that obviously will you want to be a bit careful of in terms of So you've got to pick the eyes out of the players there. Go with the strength, I think, but there will be speculative, and there has been a lot of speculative interest, and some have done very, very well out of it. We in the US cover Albemarle, and we think that's a pretty recent. The fair value is it's probably selling at a discount to fair value, but the direct exposure here is probably more speculative than others.
Okay, great. So let's move to a different sector, try something new. So why don't we move over to financials? We got a couple questions there. So John's asking a question about Macquarie. So he says it's one of his anchor investments, and he's talking about the recent report and the price rise in Macquarie. So yeah, what do you think of the prospects there going forward?
Well, I mean, the Millionaires Factory has created a few millionaires as shareholders, and they are, a very, very solid, kind of operation globally, not just in Australia. Their asset management operation, I think Nathan wrote in this week's Your Money Weekly that he expects their asset management operation or division to be managing something like about $850 billion worth of assets by 2025. They're at the forefront of infrastructure, if you like, energy infrastructure. They're very, very flexible. They are quick off the mark to see things a little bit earlier than their competition, and that's shown in just how they have performed over years and years and years. Going forward, we think the stock is probably a bit overvalued at the moment. It's probably got away, and our fair value is still 135. I think the stock's got a 17 in front of it. All the divisions have to fire, not just one. And they have they're an investment bank. They've got operations, across that spectrum, and some of those operations, you can't have it all your own way. We'll face some challenges in the commodities space, but elsewhere. But generally speaking, I mean, it's a fine company.
Okay, how about we move over and look at Magellan? So Magellan obviously hasn't had the greatest year. So Warren's asking a question saying, why is Magellan tanking so hard, down to about $40 from $60 a year ago? So any thoughts on Magellan?
Yeah, well, it's interesting. that Magellan and other asset managers, if you like, I mean, Platinum haven't done all that well, despite the fact that we've got stock markets at record levels. The people, the investors will get very, very fluky, and my gut feel is that it's possibly an opportunity in Magellan if you're taking a longer term view, and with asset managers you have to do that. Don't forget that no matter how good you think any picker is, you can't get it right all the time. And Magellan, their performance fees were down in the year just ended because they had a very, very good year the previous year. And they got a few things wrong as well, and they admit it. I mean, I love people who admit they're wrong, and the quicker they do it, the better. If they don't admit they're wrong, then they're going to have real problems. But Magellan, Hamish is a very, very a good manager of other people's money, and I think that if you believe these markets are toppy, as I do, and particularly some of the big techs, I think that you should just remain cautious. If they come down and EFTs are loaded with those FANGs and big techs, if there's any sign of nervousness in that space, and if you see interest rates or anything that might upset the very, very cozy position that some of these alleged growth stocks are in, and the rate and next minute your discount rate is not what it is today, then, and the ETFs say I'm out, or I want to reduce my exposure, look out. And so that will Magellan is a fund that's has basically got a rifle, not a shotgun, is very focused on, and with few, it hasn't got 200 stocks in its portfolio. I think you've just got to be a little careful. As I said, it's interesting. Those stocks are under pressure, despite the fact that Nasdaq and S&P are at peaks or near peaks.
Yeah. So Phil has a bit of a follow-up question there. He's saying, are ETFs, now obviously, Magellan does have ETFs. They do have ETFs on their funds, but I think Phil's probably asking more about passive ETFs. So you think that's a big risk to firms like Magellan and Platinum as more and more people move into passive investing?
Well, yeah, I think what happens is that the older you get, the more passive you become, and we're all getting older, but a lot of people just say, okay, well, I'm not really very good at picking my own portfolio. I'll get someone else to do it, and that's where the passive investments have come into their own. And of course, ETFs being at the forefront. I mean, it's basically been, I don't really, until they've, you can get an ETF on anything now, whereas going back 10 years ago, it was basically vanilla index, and you just said, I want exposure to equities, and so you just go and buy an ETF. These days, you can go and buy, as you know, an ETF on anything. But again, value, they're agnostic on price. They don't know if they're buying stocks high or low. If the flow of funds is, if there's an inflow of funds, they just got to go and buy the stock. They have to buy the stock and get set very, very quickly within basically days of that inflow. So if the market weight, how it works. If the market weights Amazon at 10%, well, they've got to put 10% of the inflow into Amazon. Whether Amazon is overvalued to hell, it doesn't really matter. They've got to do it. So the computer is putting the order on, and vice versa. When someone says, okay, I think the time is right, I want to take some money off the table, the ETF they'll be hitting the bid, not the off. They won't be, arguing about the what price the thing. They just hit the bid, like on the way in they're hitting the offer. So again, they can work against the market, if you like, because when they say sell, they're just hitting, as I said, hitting bids. The active fund manager, who might have a bid in the screen and he can see that the ETF is a seller, or the flow is so large that he'll detect that that the ETFs are selling, he's going to pull his bid because he can. The computer can't, but he can, and so the active guy can sit there and just keep pulling it down, and that will accentuate the fall or rise in the market. So those things have got to be, you've got to be very careful as to if you're going to trim the top off your own individual fund vis-a-vis an ETF doing the same thing, well, you won't have any impact on the market, but the ETF will. So these things, the passive investments have taken a lot away from the poor investment manager, active investment manager, but it's created opportunities for the good ones, and Magellan is one of those.
All right, let's move over to the banks. We've had a couple questions about the CBA buybacks. Of course, we've talked about income, or we've talked about cash being returned to shareholders through dividends. Yep. We've also had buybacks. So, any view on the CBA buyback?
Well, the buyback is returning to shareholders the surplus capital that's on their balance sheet at the moment, and there will be another one around the corner because there's still surplus capital there. They have excess franking credits as well, and so the off-market buyback is the way to distribute the franking credits. You'll find that the on-market ones tend not to have franking credits to distribute. But there's no bargain there. If the 14% discount rule generally applies, and then if you wanted to take the top off CBA, then you have to look at the situation in terms of where you what tax bracket you're in, and you and your accountant have got to figure all that out. My gut feel is that banks have had a very, very good run. I think there will be macroprudential measures introduced by APRA to put a lid on housing prices. You saw only the other day where a lot of companies are now going into using the corporate bond market more, and so they're getting a bit more flexible in terms of how their balance sheet is being managed, and so you just got to be a little careful as to where the demand for credit's is it going to continue at the same rate? We've had a boom in housing. We know that personal's not significant anymore, and the business, as I said, they're looking. Their balance sheets are in reasonable shape. They're using the bond market, corporate bond market more, and the surplus capital that's coming back from the four major banks. Some of it is because, don't forget, they didn't pay much of a dividend in 2020, so their retained earnings were much, much higher than they normally would be, number one. Number two is that they've got a lot of divestments going on, and what are those divestments? That's the admission of a mistake of past years. They were going to be brokers, they were going to be fund managers, they were going to be selling you insurance, they were going to be this, and this. The fact of the matter is they were bankers. They were hopeless at the rest of it. And the surplus capital that's coming back to you now is an admission of the mistakes they made in the past, with a haircut for you, the shareholder, because they didn't get back as much as they put out. Now, so overall, You've had, a lot of, you've had hundreds of billions of dollars pushed into this economy through fiscal support from the government. You've had household income increasing in a recessionary environment, which is unusual. So the banks have done reasonably well coming out of the 2020 blip. They overprovided initially. Now a lot of the increases in their bottom line is coming from reducing the impairments significantly. 2022 will get you a much clearer picture as to what the landscape looks like, and also 2023. My gut feel is that the profits growth will be a bit more modest, significantly more modest than you've seen in 2021. And the dividends will probably just ease, and will probably go up a little bit more. The payout ratios have probably going to settle around about the 70% mark.
Okay, you mentioned particularly with the CBA buyback, how obviously your tax situation is going to impact that. So we do have a question from Rod around that. So he said, great results have encouraged several large companies to provide buyback opportunities that appear to be focused on the low taxed shareholders. Can you discuss the fairness of this for other shareholders and what can be done to share the joy?
Yeah, well, it's a very good point. Buybacks, in my opinion, the jury's out on them because of exactly what Rod has said. Overseas investors don't get a go at it. It's all about franking, and those who are in tax shelters, like super funds, particularly in retirement mode or in pension mode, pay no tax, and therefore it's heavily biased towards them. In my opinion, what they should have done, or what they should do, is they should make special dividends. The share buyback, they're buying back, I don't know, it's probably less than 2 or 3% of the capital. You're going to get about that much of your shares, bought, if you like, and maybe a little more because other people won't participate. So it doesn't move the needle much in terms of increasing the future earnings per share because your capital base is lower going forward. When you make a big buyback, like 10 or 15%, you do move the needle. But when you're playing around the edges of 1 and 2%, it's basically meaningless. So, but don't forget, these franking credits, they are the shareholders. They're not the companies. You can't find a line in the balance sheet that says franking credits. They have no value to the company. They only have value in the shareholders' pocket, and that's where I think you've got to distribute them some way, and why not cut a check and with a fully franked dividend? But a lot of companies don't like cutting checks, because they're not the buyback. They're not, they're buying back your equity, and so they are writing a check. But this is it's also helping their capital position. Whereas the other way, I think I'd defer. I'd rather have a dividend than some of these buybacks.
All right, so we're getting close to 1 o'clock. Why don't we sort of end on a macro question? So. Christian has asked, do you think inflation is coming? If so, how much and how long? And is also asking about what is the best way to hedge, US dollar or gold, or 2 suggestions that Christian put in there, and just wanted to hear your thoughts on inflation.
Goodness, we could be here till 5 o'clock. Look, my feeling on inflation is that it may be transitory. and that's the spike. The spike, it will be transitory. Yes, you can't have a second-hand vehicle selling more than a new vehicle, if you like, which is kind of what you have. I mean, people are waiting 10 months for a new vehicle, so they go out and buy a second-hand one at almost the price of a new one, which doesn't make too much sense to me. But that's in the US, they're making a big deal of that. Here, well, I'm sure it's the same kind of situation. But my feeling is that there's been so many costs added on to operations because of COVID, and that they will stick. A lot of them will stick. Going forward, you will still be having sanitizer. You'll still be having this. You'll still be having it. There's a lot of things that just are going to change permanently going forward. So whilst inflation might be, let's just say it's 2% and it goes to 5%, which it kind of is now, I think that it's not going to come back to 2. It's going to come back to 3. In other words, so it has gone up 50%. And that is what I think we've got to focus on. And I'm a firm believer of, I don't believe that the core of the core CPI excluding food and energy. What does a household do if it's got no food and energy in their equation? Well, they won't have a household. So why? I mean, it's just in my opinion, it's a nonsense number. Headline is what we're paying for everything day in, day out, and to strip out the things that are most necessary, like food and energy, is I just can't understand it. So I think that the central banks are in a very, very difficult position at the moment, but the developed world central banks have got themselves into a very, very difficult position. I think they've painted themselves into a corner, and the exit door is nowhere near that corner. The unconventional is going to be very, very difficult to unwind. I don't know how they're going to do it. You've seen the Fed Reserve balance sheet double in size in 2 years. The ECB's up 80%. We are up 80%. The Japanese are up 27%. And have a guess what the Chinese are up. The Chinese POBC balance sheet is only up 6% because they didn't go unconventional. They didn't go out and buy bonds and other paper. They, as I said, poured concrete and used the conventional monetary policy, and they haven't got a problem. The central banks, when this taper comes, it could be very, very sticky and very, very difficult to get out of. And I said, I don't know. Now, in the inflation situation, I think it's going to be more permanent because I think than people think. How to protect yourself from it, I don't think it's the US dollar, because all they've done is printed so much of it, so that's diluting what's already out there. Is it gold? Well, you can always have a little bit of gold, but I just think you have to. Is there any inflation protection? Look, companies like a little bit of inflation. The retailers, supermarkets and all that, they like a bit of inflation. So I just think that you stay with the investments where they're necessities. You play it that way. If everyone needs them, then that's how you invest in those companies where there's total demand is rising for, as I said, food, energy, financial services, those type of things. The demand is going to continue to increase. And the prices will increase. So that's if you're invested in them, you are giving yourself some inflation protection or benefiting from the inflationary environment.
All right, Peter. So thank you for that. I think it's a good place to end. So we'll stop right there. But thank you guys very much for joining. Appreciate it. And thank you, Peter.
It's a pleasure. Always enjoy these type of things.
Wales. Yep. Right. Anyway, thank you guys very much for joining. Thanks, Peter. And we will talk to you soon.
Okay.
Any advice in this video is general advice or regulated financial advice under New Zealand law prepared by Morningstar Australasia Proprietary Limited and or Morningstar Research Limited without reference to your financial objectives, situation or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.